Howdy there, folks. Welcome into today's video. Oh, baby, am I looking forward to getting into this one with you guys here today, okay? First off, I do not usually do reaction videos here on the main channel. I usually do those only on my reaction channel, which, by the way, just hit a new all-time high subscribers, so I appreciate everybody that's subscribed over there on Jeremy Lefebvre Makes Money, my reaction channel. But today, this one was so big, I thought, let me go ahead and react to this actually on the main channel here today, okay? So I want to watch about the first 10 minutes or so of Fast Money here that I actually just got done going through, and I thought I would react to this, kind of give my opinions. And the reason being is they got Danny Moses from The Big Short on, okay? He's extremely bearish, okay? And they also have this man on, Dan Nathan, who's also generally extremely bearish. And then they have this gentleman on who definitely leans more to the bearish side, at least this year, okay, I've been noticing. And so they are going to give us the bear case up and down and all around, baby. And so I thought, man, this is so perfect. And the reason I think this is important to watch something like this is to hear the bearish perspective. Think, you know, do I think those things are realistic? Do I see it a little differently and things like that? And especially when you're in a more of a risk-on market, let's just call it what it is. This year has been absolutely flipping flapjack and amazing, okay? If you haven't made this money this year, like, you must be short the market or something like that, okay? Public count had a light day today. It was a $17,000 up day today. That's kind of for the public count. This year, that's kind of like, okay? We just hit a new one-year high for the public count, right? And going into this year, we were around, I think, $1 million, maybe just under $1 million in this portfolio. And it has just been absolute beast mode. So the more risk on in a market we go, the more I like to kind of hear, what are the bears talking about? What are they saying? Does it hold weight? Is it the same points they were making 6 months ago and 9 months ago, right? And so, yeah, I appreciate everybody joining me as always. Thanks for being subscribed, folks. And let's just get straight into this.
A couple of guest traders, Danny Moses of Big Short fame. He's the founder of Moses Ventures, and Cameron Dawson, CIO of New Edge Wealth. Welcome to you both. We start off with the market melt up on Wall Street. Stocks surging to their highest levels in over a year. The Dow up for a 7th straight day, its longest winning streak since March of 2021. Tech stocks leading the charge, the sector the biggest gainer in the day, and now up 47% since January. Check out this chart. Tech valuations closing in on record highs. Forward PEs are at levels not seen since December 2021, when the world and the market was a very different place. So with stocks rallying and tech valuations nearing record levels, when will the bears throw in the towel? And I asked this in the company tonight. Basically, it's a bear den on the desk tonight. So we're going to have this conversation because it's a good one to have. When do you say you got to trade the market you have? When do you say I'm being too dogmatic about my stance and my predictions as to what is going to happen? Guy, I'll start off with you.
Well, it's great to have Cameron and Danny here. We're sort of safety in numbers, I guess, tonight. But I've been on the bear camp in the broader market for quite some time, incorrectly since probably December of last year when this whole thing started. But, you know, valuations were stretched then, or even more so now. And you think about where the world was December of 2021-ish. I mean, interest rates were so effectively zero. The Fed was just going to start to raise interest rates in March. 500.
Yeah. Okay. Hold on. Okay. Hold your flipping flapjack and horsies, because we're acting like the world was much better then than now. Was it really? Because if you go back to the end of 2021 going into 2022, we had inflation that was starting to get out of control, right? We had commodities that were on this mega bull run. We knew, oh my gosh, the Fed's going to have to start raising rates. It's going to do it aggressively. We don't know how fast they're going to go. We don't know how high they're going to go. There was a lot of uncertainties. You look at the world now, you have a CPI at 3%. You have, if you look at truflation, we're in the 2s right now. And so there's a very much possibility over this next couple months we could have 2s for inflation, which is right where the Fed wants us. The Fed, if you want to say they're not done, you could at least say they're very close to being done, right? So you look at it from those factors and you say, well, is the world really a scarier place? We've already had a deal with Russia-Ukraine, so that's a situation, right? It looks like the U.S. and China are trying to be a little more friendly, and we've gone through all these rate increases, and the economy's held up decent, which has been kind of shocking, to be honest. Even for bulls, it's been pretty shocking how well the economy's held up and how low unemployment has stayed. So to say it's a scarier world now than, you know, let's say 18 months ago, 19 months ago, 20 months ago, I don't know about that. If anything, it's probably a more comforting feeling.
Points later, here we are. And again, the market's going on its merry way. I'm hard-pressed to believe, after what's going to be 525 basis points of hikes over the course of a year and a half, There's nothing to it. There's nothing to worry about. There are no ramifications. Nothing is broken, and the market goes on its merry way. It just doesn't.
And absolutely, there can still be problems. Like there could be the Fed lags kick in, right? And, maybe we haven't really seen it hit the economy very bad yet, but maybe it starts to hit in 3 months, 6 months, 9 months. So I wouldn't call us necessarily out of the woods in regards to this, and that is a risk factor of the market is what happens with these Fed lags. What if the Fed, let's say they raise Fed funds rate up to 5.5 or 5.75, and then they just keep it there for 9 months, 12 months. Can the economy stay together in that sort of environment? We got to see.
A lot of sense to me.
Danny?
People came into the year short technology, long energy and financials, somewhat defensive, as was I. And over a period of time, the chase began. When the tech stocks started to run, people forgot about energy and financials, obviously, until the March blow-up of some of the biggest banks in the country. I think about two big events that happened in the first half of the year. First one, obviously, was Silicon Valley Bank and Silvergate and all the banks blowing up. What happened as a result of that 95% of people didn't see coming was the Fed, Treasury, basically guaranteed all deposits going forward, in my opinion. That's what they did, and they injected $500 billion into the market. The second thing that happened was the debt ceiling crisis that happened. What happened as a result of that? We have an unlimited debt ceiling now through January 2025. Those I did not have on my bingo card as a result of that. That being said, as we sit here today,
So what Danny Moses just did is the cardinal sin, and that is the cardinal sin that I also did in a very bad way going into 2022. So going into 2022, I thought a lot of things were going to go a lot better than obviously what happened, and every single thing went worse. Inflation got way more out of hand than I thought I was going to get, right? It kept going higher and higher. Russia-Ukraine happened. Commodities went even higher than I expected. Everything went against what I thought was going to happen in 2022, right? I got way too bullish. I did not consider enough risk. Danny Moses did exactly what I did, just on the flip side, right? He was all bearish. He's expecting everything to be bad, all debt ceiling problems, all this and that, and just everything has come in better and better. Inflation expectations. These guys have been so bearish as far as what the numbers came in, and they've just come in better and better and better than the bears expected. This is why in this game, you want to lean bullish. You don't want to get too far over to the perma-bull, insane bullish side, but you also don't really want to be over there on that bearish side, because a lot of times things will go better than you expected. That will happen, right? And so it pays to kind of be a little more even, but on the bullish side. So if you're going to be on one side, be on the bullish side, but just don't go too far, I guess you can say.
S&P earnings have gone down in 2023 since we've started the year. And in 2024, they've gone down since we started the year. So I'm hard-pressed to, quote, chase the market here. That being said, I'm sure we'll talk about it later, there are names you can own.
You could also say, well, then that's an opportunity for a lot of these companies to come in and beat earnings substantially.
And still be bearish on the overall market.
Right, and that's sort of the stance that you take, Cameron. You're finding some pockets where you do want to invest, but overall you're a little bit cautious.
Yeah, and what we've learned this year is that valuations don't matter when everybody's underweight or everybody's short and bearish already, which just means that people get drawn into the market kind of regardless of what valuations are. But now if we look at where positioning stands, we're at a point where you've seen huge inflows into tech. You're now about 75% of the way from going deeply underweight to very overweight. So you still have a little bit of room to run to get to that max overweight position. And once you get there, that's probably when valuations start to matter. And that's why if we're looking at positioning today, we're saying we'd rather buy names that are cheaper, that equal weight index, for example, trading at about in line with average versus growth trading well above average. So I think valuation discipline makes a lot of sense if you're looking out 2-3 years. But if you're only looking in the next couple of weeks, the best trends are in those growth names.
Yeah, I mean, no doubt about that. And I think, though, really the question is, what's the pull forward, right? And so if we want to talk about valuations, like I'm looking at this is facts that they track, the forward 12-month PE of the S&P 500 is trading near 19 times. That's above the 5-year average of 18.6, above the 10-year average of 17.4. And Danny just started this conversation by talking about S&P earnings expectations. They are still up, I think, expected to be up 2% year over year, but they're down from where they were massively a year ago or something like that. that. So I say to myself here, what are the names that are driving all this performance? We know that the 7 stocks make up 26% of the S&P 500. We know that they are a disproportionate amount of the expected earnings growth for that index that I just told you is trading at historically high levels. And then if you think of all the excitement in and around those names, they are pulling forward a lot of excitement around something that might or might not materialize. And then,
okay, all right. So, Dan Nathan, got to give him love. He makes a great point. The more a stock price goes up, the more it's pricing in a lot of things to go right for it. That's just how the stock market game works, right? If you were to tell me Tesla stock goes up another 100% for the remainder of this year, it just priced in a lot more growth, right? It's a very simple equation when it comes to that. So I think he brings up a good point. I don't think necessarily that the end-all be-all in regards to this, because many of these companies sometimes can just keep beating on their earnings, and things just keep going better and better than folks really had foreseen in regards to these stocks. So that is something to take into account. But there's no doubt, like if, let's just say the whole stock market doubles. Let's say the next 6 months, the whole stock market doubles. The NASDAQ, S&P 500, Russell, Dow, everything. Okay, we just pulled through massive, we basically just took massive future returns and just took them into the now, right? Took them into the present. So that's an important, valuable point he brings up.
So distant future. So to your point, Cameron, these are great trends to invest in. This is what investing in technology is all about. And that is, I think, the history of all of our careers in the markets over the last, let's say, 25 or 30 years. But sometimes when it feels like a feeding frenzy, it's not exactly a great time to kind of jump in the pool, if you will.
We're not talking about, though, pets.com here. We're not talking about...
Okay, but Mel, all right.
We're talking about companies that were already large and profitable.
Okay, we are. Okay, but Microsoft came into today. It was a $2.5 trillion market cap company. They put out a press release at 11:30 about a part of a business that we know very well. This is a company that has gained more than 40% on the year, and we know why it has been rallying this year. And they're talking about a product that might get to $10 billion in sales. The stock rallied $130 billion in market capitalization on that. We don't know what the cost of compute is for that service that they're offering to enterprise clients for $30 a seat. We don't know what the cost of the data centers are going to be, the demand for those sorts of things. Those revenues that might or might not come might come at really crappy margins. You know what I'm saying? So to me, I just think that Microsoft at 33 times, and I know we're going to do it in the E-block, sorry, Sandy, but this is really important stuff here, because this is the thing that market participants are jumping into right now. And if we go back to the S&P and where it's trading and what expected earnings growth are, if you look at those 7 stocks, if you take them out, the rest of the S&P is not expected to grow. The areas that Danny talked about that everyone came in really defensively positioned are not going to have a great year right now.
I would just add that, just to go back to the start.
Okay, before Danny Moses, big short man, gets rolling here again, okay? Dan Nathan, unfortunately, is making a monumental mistake here, okay? And this is crazy because these guys have been in the market so long, you got to eventually come to this sort of reality. What Dan Nathan wants is he wants a company to be able to put up the numbers, and then after that, the stock price moves up. So he wants Microsoft stock to stay in a range, and then when they start announcing these, the $30 a month things starts rolling in, then you can get a valuation move up. It's not the way stocks work. It's not the way the stock market works. Things get priced into the future, right? People are looking at that and they're starting to run their numbers and their projections, and they're saying, okay, I think they're going to be able to pull in this many customers this year and this many customers next year, and I think the margin is going to be about here. And so, wow, this is actually a great deal to buy Microsoft stock right here. Okay, I don't own Microsoft stock. I don't have plans to buy Microsoft stock, but I got to say, that's the way the stock market works. It would be a lot easier game if you got to wait until the numbers came in for everything, and then it was got you the green light. Now we can go ahead and buy it because the numbers are here. It's not the way the market works, especially in regards to more growth-related stocks. It's looking to the future, and people are going to get ahead of that. And sometimes by the time you get to that moment in time, the stock's already ran significantly, 50%, 100%, sometimes hundreds of percent, and then it starts to roll in the money, and you start to understand, oh, I see why the stock went up 50%. Oh, I see why it went up 100%. And it all starts to make sense. So, yeah, man, that's, people have a very specific view on the way they wish the market worked, but the market doesn't care what you think the market should work and when you think a stock should go up or down.
Came into the year, and I believe Fed funds were predicting a rate cut at this next meeting. We've now pushed that out 6 months. It kind of feels like everything's been pushed out 6 months from here, right? So economic data was better than expected on the margin. There is no question about it, but I think all we've done now is push this out 6 months from now. I'm not necessarily calling for a recession to happen or trying to time it, per se, but these rates being this high for this long, you're starting to see an impact. I know we're going to talk about the banks and consumer credit, but it's happening, and the consumer's getting stretched here.
So you hold on basically to a negative view of the market. Are you short the markets currently?
I'm short the S&P, yes.
Have you been short the S&P throughout the entire year?
No, I've not been short throughout the entire year. Recently got re-engaged at these levels, and if I'm wrong, maybe I'm wrong by a couple percent, I feel like.
At what point, because it's the start of the year, you're more defensive, right? At what point did you say, you know what, I'm going to walk away from this, I'm going to be flat, and I'm going to wait for my opportunity?
When stocks stop trading on fundamentals, which I believe what Dan's talking about has happened to a degree, you can't really short a market that doesn't trade on fundamentals because there is no limit to where it can go. So a little bit scary.
You know, we talk about $150 billion over the course of a couple of days. It's not a big deal. A year and a half, 2 years ago, how many companies had a market cap of $150 billion in the first place? And now companies seemingly add that over the course of a trading day or so. We don't even bat an eye. And it's not on anything necessarily fundamental. To Dan's point, it's all on money flows and the fact that they're probably just an absence of sellers right now. Question is, what's the catalyst for that? And I think valuation will be that at a certain point, but you can never really trade on the back of valuation. But there's something coming, and I do think, you know, Sheila Bear is going to come on. I think it's going to manifest itself in another one of these regional banks or maybe a credit crunch cycle, whatever, rearing its ugly head. Then it starts to build on itself.
But to Danny's point.
Spoiler alert, Sheila Bear did go on, and she did basically say there's going to be more bank failures.
The Fed stepping in and effectively backstopping all deposits, doesn't that sort of eliminate the risk of another big failure that we've seen?
It eliminates that risk, but it doesn't eliminate credit risks that are clearly going to be out there. I mean, you think about what's, again, over the last now 18 months, what we've raised 500 basis points, soon to be 525, historic in the amount and the duration with which we've done it. People think somehow the economy can weather that storm, and it has. The lag effect clearly has lasted longer than I thought, but it doesn't mean it's not going to happen. There's an inevitability to all of this. Can
I ask you guys about the possibility that there's an echo chamber going on? You guys 100%. Are on a podcast that everybody knows. Lots of reviewers. You three are together. You're talking about your bearish views all the time, and it happens also on the bullish side. I might add, it's not just you guys. It's who you keep company with. You tend to gravitate towards people who you share views with. Are you concerned that your view of the market?
This is why a lot of people don't understand why I go out of my way to watch bearish perspectives or bearish views and things like that. I'm an optimistic person. I'm going to lean optimistic. I'm going to lean bullish. So I need to hear bearish perspectives. I need to, I want to hear that type of stuff. I need to seek out that type of stuff. And so I love to watch channels or listen to folks that have bearish views. And then try to justify, okay, does that make sense? Does it not make sense? Do I agree with that? And it just kind of keeps me a little more balanced. So that is important because a lot of these bears, they don't get out of their bear caves. And they just stay and they're just like, everything's bad and the world's ending and, everything negative. Bulls do it on the same side with certain stocks, and they only think about the positive and they only surround themselves with bullish people and they only watch the bullish views. And I can just tell you, it's important to look at both sides of it. If you're in an individual stock, look at the negative side, look at the good side. They both matter in a significant way.
The world right now at this moment is really shaped.
Birds of a feather flock.
Right, exactly.
Yeah. No, I'll jump in quickly. I think that's an extraordinarily fair point you bring up. And we have people on with the counterview. We listen to him. I think Danny will say this. I don't want to speak for him, but he embraces when people challenge his positions, and he can talk about that because you do want to hear the other side. And I think there is a fine line between being dogmatic and having a strong opinion, and we're probably right on the cusp of it. But what I'm seeing going on right now in terms of the economy, in terms of interest rates, in terms of the moves in the bond market, currency market, the gold market, which Danny will talk about, it all to me lends itself to an equity market that's overvalued.
Yeah, and here's another thing, okay? It's absolutely laughable because I spent all of 2022 watching almost 90% of the strategists and pundits defending their bullish view the whole way down. And it wasn't even that the S&P only closed down 20%. A lot of stocks that a lot of people who watch this show lost 75% of their value. And those people are making all the stupidest arguments about why it's going to be, like why you continue to hang on in this and that, whatever. So, as far as I'm concerned, I think it's a valuable, it serves as a valuable service because, I've been on this network for 14 years and I always find it really interesting that, a lot of folks here, they come on here and they can talk out of both sides of their mouth and you push them and a lot of the great journalists on here push them. At least I'm here every day and I'm talking about it. I'm giving up. I'm coming with new stuff. You know what I mean? And I think that transparency is kind of the only way to do it, but I'm not going to change my mind every other day.
Right.
Listen, part of it is having a front row seat for the financial crisis in 2007 and 2008. It's hard to unsee everything that happened. And I really go out of my way to try to teach people and help people. And we pitch longs on the podcast from time to time. But once you see something like that happen, when you think about the bank crisis in mid-March, 99% of people had no idea what that was. We were talking about guaranteed government securities that were getting marked down. These weren't subprime mortgage bonds, right? And that's a scary prospect. So there are things like that occurring right now that no one's really wants to pay attention to. I see them, try to help people, but it's not manifesting itself right now in the markets, but I believe over time it will.
Let's get to our chart of the day because this is something that
and that wraps up kind of the conclusion here, okay? But I think the very important thing I need to mention right now, okay, is what happened in the great financial crisis screwed up a lot of things in a lot of different ways on kind of the government side, the way the Fed acts. It screwed up a lot about a lot, okay? But one of the things that never really gets mentioned is mentality. And because that was what it was, all indexes dropped 50%, we had such a crazy banking collapse, such an epic recession, housing prices fell. Now everybody thinks every recession is going to be a 2007 through 2009. They believe the indexes are all going to go down 50+%. They believe housing prices are going to get smashed. They believe all this stuff. And there's a lot of folks that thought that's where we'd be right now. They thought, like, if you go back 9 months ago, 12 months ago, a lot of these bears believed that's where we would be right now. We would be in that, insane crash right now. And there was a lot of people that were predicting that right now, the S&P 500 would be 3,000 or less. The S&P 500 right now is over 4,500, and this is one of the reasons I love having my reaction channel, right? Jeremy Lefebvre makes money, because on there I get to hear all these perspectives and I get to react to them. I get to post kind of my opinions on those. And I reacted to guys that were saying S&P 3,000 right now. We're talking 2,600, 2,800. We're at what, 45, 4,600 on the S&P 500. It's not even remotely close. And the economy's held up way better than anybody expected. And so, yeah, I think 07, 09 really screwed up a lot of people because they automatically assume something's going to go bad and it's going to be this epic thing when sometimes it is and sometimes it isn't. We had a pretty epic crash last year. I mean, the greatest companies in the world were down 50, 60, 70, 80%. And a lot of these gentlemen and ladies didn't even take advantage of that. See, how often do you get that? Like, these are supposed to be historians of the market. Tell me how many times you get the greatest companies in the world at 50, 60, 70, or 80% discounts. I'll tell you how often. It happens every 10 to 15 years. Every 10 to 15 years. That happened last year for the greatest companies in the world. And a lot of people didn't take advantage. It is what it is. So, nonetheless, folks, we're not out of the woods by any stretch of the imagination, but things have been going a lot better than the bears predicted and expected. And this is why it always pays to be, bullish over the long term. You can hedge a little bit to cover yourself just in case the market goes down. I'm hedged this year. I'm going to hedge next year just in case the stuff hits the fan. I'll make a ton of money on the downside. And other than that, stay focused, stay buying stocks, stay taking advantage of deals out there. There's a lot of deals in the value stock category, dividend stock category, and there's a few deals still in the growth stock category. Appreciate everybody joining me as always. Hope you guys enjoyed this video. Much love. Thanks for being subscribed. If you're looking to access any of my good stuff, like follow me on IG or get my free stock picking checklist or anything like that, check out the description area. Much love and have a great day.